You know, most traders look at a chart, see all those squiggly lines, or maybe they see a big news headline, and they think, that's it, that's what moves the Forex market. But the truth, the real drivers are buried way deeper. It's not really about the patterns, it's about money, it's about huge decisions, and it's all about expectations. So let's peel back the layers and see what's really going on under the hood. So let me just ask you this straight up. What if the entire foundation of what you think makes prices go up or down is, well, just wrong? What if it's all a surface level illusion and the real game is being played with a set of rules you were never even told about? All right, here's what we're gonna do. We're gonna peel back the layers of the market, one by one. We're gonna move right past all the common myths, the indicators, chasing the news, thinking it's all random, and we're gonna get to the core reality of what actually moves trillions of dollars every single day. And it all boils down to three things: money flow, expectations, and the massive decisions made by just a handful of powerful players. Okay, let's start with layer one. This is the most visible part of the market, right? The charts. This is where most traders live and breathe, just staring at patterns and lines all day. But here's the thing. These are just the surface illusions. We're about to find out what they really represent. This right here, this quote, changes the whole game. You know those support and resistance levels you've drawn all over your charts? They aren't some kind of magical force field. Nope, they are simply predictable places where thousands and thousands of traders have put their orders, and more importantly, their stop losses. For a small trader, that stop loss feels like a safety net. But for an institution, it's literally a treasure map pointing to where the money is. And this is where that treasure is buried, in what we call liquidity pools. Look, if you're an institution and you need to buy or sell, say $500 million worth of a currency, you can't just click a button like we do. You'd move the market against yourself. You need a massive pool of orders on the other side of your trade. So where do you find them? Exactly where everyone else put their stop losses. To them, your stop isn't protection, it's the fuel they need to get their huge orders filled. Okay, so let's go a level deeper to layer two. This is all about the triggers, those events that seem to cause these big, sudden moves. But here's the secret. The event itself doesn't really matter. What matters is how that event compares to what the market already believed was going to happen. This is so important to get. Markets do not react to news. They react to surprise. Just look at the table. When inflation comes in just a tiny bit above what everyone expected, the market basically yawns. Nothing happens. But when it completely shatters expectations, whoosh, you get a massive, violent move. Why? Because all the big players had already placed their bets on the expected number. The surprise is what forces everyone to scramble and reprice everything instantly. And that right there, that is the fundamental difference between amateurs and professionals. Retail traders see a headline pop up and they react. They chase it. The pros? They were already in their positions, waiting. They use the news release to take advantage of the predictable panic and excitement from the crowd. They trade the expectation, not the final number. Another one of these huge triggers is something called global risk sentiment. The easiest way to think about it is just the market's overall mood. When everyone's feeling confident, optimistic, we call that risk on. Money just floods into currencies from growing economies, like the Australian or New Zealand dollar. But the moment fear takes over, a risk-off environment, that same capital flees for its life, running to what it sees as safety, the US dollar, the Japanese yen, or the Swiss franc. And this creates these huge, powerful trends that can last for months. Now we go even deeper, to layer three. If news and sentiment are like the daily weather, this next force, this is like the gravity of the entire Forex market. It is without a doubt the single most powerful long-term driver of any currency's value. And I'm talking about interest rates. This simple quote right here explains everything you need to know. Think about it. Trillions of dollars of global capital are constantly scanning the globe, searching for one thing, the highest, safest return on their investment. And a country's interest rate, that's the main scorecard. Higher rates track money like a magnet, lower rates push it away. It really is that simple. I mean, just look at this chart. It makes it so obvious, doesn't it? If you're a global investment fund with billions of dollars and you have to choose where to park your cash to earn a return, where are you going to put it? In the US, earning over 5%, or in Japan, earning basically zero? It's a no-brainer. This difference creates a powerful gravitational pull of money from one currency to another, and that's what drives those big long-term trends. So who are the conductors of this massive financial orchestra? The central banks, the Fed, the ECB, the Bank of England, the Bank of Japan. These institutions are the ones pulling the strings. They control the interest rates. And their decisions, their press conferences, heck, even a single word in one of their statements can shift the flow of billions of dollars in a heartbeat just by changing what the market expects them to do next. And that brings us to the final, deepest layer of them all. Layer 4, the real players. We've seen the map, we've seen the triggers, and we understand the deep currents. Now let's look at the actual whales that are making the waves in this ocean. Because make no mistake, this is not a democratic marketplace. It's an ocean completely dominated by a few massive creatures. Let this sink in for a second because it's absolutely critical. The combined actions of millions of retail traders like us, all we do is describe where the price has already been. We are followers. It is the focused, deliberate, powerful action of a few massive institutions, the big banks, the hedge funds, that actually moves the price from one point to another. So how do they actually do it? Well, it's pretty much a mechanical process, almost like a brute force attack. First, they use passive limit orders to build these invisible walls of supply or demand at certain price levels. Then, they come in with huge, aggressive market orders to attack and absorb every single order sitting in that wall. And once that wall of liquidity is completely eaten up, price has nowhere else to go. It instantly jumps to the next level to find more orders. It is a pure game of force. So let's put this whole puzzle together. Here's the real framework. Layer 1, the surface. Your charts and technicals are just maps showing you where the liquidity is. Layer 2, the triggers. Data and sentiment only move markets when they deliver a surprise. Layer 3, the deep currents. Interest rates are the gravity that dictates where big money is going to flow. And finally, Layer 4, the real players. The institutions are the ones executing their plans based on all of these other forces. That's it. That's the game. You see, the market isn't a fair and democratic playing field. It's a battlefield. It's an arena specifically designed to transfer wealth from the pockets of the unprepared to the prepared. So now that you understand the real rules of the game, the only question left is this. Are you going to continue to be the hunted, or are you going to start thinking and acting like the hunter?
If you want more content like this, make sure to subscribe. And to get started with trading right now, check the link in the description. See you there.